Only 4% of the world's people live in the United States, yet its currency drives nearly every oil deal, trade contract, and central bank reserve on Earth. This is how the US dollar became the world's money. For centuries, global commerce revolved around metals and the currencies of empires. Spanish silver flowed across oceans. The British pound sterling ruled the 19th century, backed by the vast reach of the British Empire. London banks financed trade, shipping, and insurance for the planet. When the 20th century began, the pound remained supreme. The United States was an industrial powerhouse, but not yet a financial center. New York lagged behind London, and the dollar was mostly a domestic tool. Then came the shocks of the First World War. Europe descended into conflict. Gold and capital streamed to the United States as European governments borrowed to pay for weapons and supplies. By the end of the war, America had moved from a debtor to a creditor nation, holding unprecedented amounts of gold. This tilted confidence toward the dollar. American exports of wheat, oil, and steel flooded world markets. New York banks began arranging loans abroad, and international investors increasingly trusted American institutions. The 1920s accelerated this trend. Wall Street's reach extended beyond U.S. borders, and foreign governments began issuing debt in dollars. The United States adopted a gold standard, which signaled that dollars were backed by a tangible asset. Foreign investors understood that holding dollars was essentially holding gold with better liquidity. While the Great Depression disrupted global finance, the structural shift in reserves from Europe to the United States had already started. The Second World War was the decisive moment. By 1944, most of Europe and Asia lay in ruins. The United States had the only intact industrial base of the major powers and held nearly 2/3 of the world's gold reserves. That year, representatives from 44 allied nations met in Bretton Woods, New Hampshire, to design a new global monetary order. They chose the US dollar as the anchor currency. Every participating nation fixed its own currency to the dollar, and the dollar itself was fixed to gold at $35 per ounce. The International Monetary Fund and the World Bank were established to monitor and finance the system. Only foreign governments and central banks, not private individuals, could convert dollars into gold at this rate. For the first time in history, one national currency became the linchpin of global finance. This arrangement, known as the Bretton Woods system, brought stability and growth for decades. International trade expanded. Central banks accumulated dollars as reserves, knowing they could convert them to gold on demand. Businesses worldwide invoiced their exports and imports in dollars because that reduced risk. American banks became the conduit for global transactions. Yet by the 1960s, the system began to strain. The United States was spending heavily on domestic programs in the Vietnam War. More dollars flowed abroad than gold reserves could cover. European nations, especially France, began converting dollars to gold, shrinking U.S. reserves. In August 1971, President Richard Nixon announced that the dollar would no longer be convertible to gold. The fixed exchange rate system collapsed. Conventional wisdom might suggest the dollar would then lose its special status, but it did not. In fact, it cemented its dominance through a new mechanism. In the early 1970s, key oil producers, including Saudi Arabia, began widely pricing oil in US dollars and holding large dollar balances. In exchange, Washington provided security guarantees, military equipment, and support. This so-called petrodollar system was not a formal treaty, but a set of practices and relationships that entrenched global demand for US dollars because countries everywhere needed them to buy energy. Oil is the lifeblood of modern economies. Most oil contracts, though not all, are denominated in dollars, creating a strong global demand for the currency. Nations built dollar reserves to pay for energy. Banks expanded dollar lending. Companies kept dollar accounts. Over time, the dollar became the default for a wide range of commodities and international financial contracts, not just oil. Beyond the petrodollar system, the United States offered the deepest and most liquid financial markets in the world. U.S. Treasury securities became the gold standard of safety. Central banks, sovereign wealth funds, and investors could park enormous sums in treasuries with confidence they could buy or sell without disrupting prices. The combination of petrodollar demand and unmatched financial infrastructure created a self-reinforcing network effect. The more the world used dollars, the more convenient it became to continue using them. Today, this dominance is visible in the data. According to the International Monetary Fund, the dollar still represents about 58 to 59% of global foreign exchange reserves as of 2023. A very large share of global trade is invoiced in US dollars, making it the dominant invoicing currency worldwide. The euro sits far behind at roughly 20%, and other currencies like the yen or the yuan are in single digits. US financial markets remain several times larger and more liquid than those of any other country. This status allows the US government to borrow at lower cost and to impose financial sanctions with extraordinary reach. The benefits for the United States are substantial. It can finance deficits more easily. Its companies enjoy lower borrowing costs. It earns profits from providing safe assets and payment systems to the world. The dollar's status also amplifies US geopolitical influence because access to the dollar system can be restricted to punish adversaries. For other countries, the picture is mixed. Holding dollar reserves gives stability, but also exposes them to US monetary policy decisions. Emerging markets that borrow in dollars can face crises when exchange rates swing or US interest rates rise. Dollar shortages can trigger painful adjustments. Nevertheless, most governments and businesses still choose the dollar because alternatives are less convenient or less trusted. Attempts to dethrone the dollar have surfaced repeatedly. The launch of the euro in 1999 raised hopes for a rival reserve currency. China has promoted the yuan for trade settlement and set up swap lines with many countries. Russia and some other states have tried to shift away from dollars in energy deals. Cryptocurrencies and central bank digital currencies are being explored as possible alternatives. Yet so far, none has matched the scale and network effects of the dollar. Why does the dollar remain so dominant even without a gold backing? The answer lies in trust and infrastructure. The United States has a relatively open economy, a transparent legal system, and strong property rights. Its bond market dwarfs all others. Many analysts also argue that the U.S. Navy's global presence helps keep key sea lanes secure, indirectly supporting trade and finance stability. These factors make dollar assets uniquely attractive in times of uncertainty. When crises erupt, investors tend to rush into dollars, not away from them. There is also inertia. International trade finance and contracts are standardized in dollars. Changing invoicing currency involves renegotiating countless agreements, rewriting software systems, and managing exchange risk. Unless a compelling alternative emerges, the dollar's incumbency advantage is enormous. This does not mean the dollar's supremacy will last forever. Reserve currencies have changed over history as economic power shifts. The British pound dominated the 19th century, but was eclipsed in the 20th. If the relative size of the U.S. economy declines sharply, or if trust in its institutions erodes, the dollar's role could diminish. A more fragmented financial system might develop with regional currencies or digital networks handling trade. But such a transformation would likely be gradual, unfolding over decades rather than overnight. In recent years, some shifts have begun at the margins. The euro and the Chinese yuan have gained small shares of global reserves. Gold purchases by central banks have increased. A few oil deals have been denominated in non-dollar currencies. Yet these are still exceptions within a predominantly dollar-based system. Even the rise of digital assets like Bitcoin has not seriously dented the role of the US dollar in official reserves or trade invoicing. Understanding how the dollar became the world's money illuminates the mechanics of global power. Unlike an empire built solely on military conquest, the dollar system rests on consent and utility. Countries hold dollars because they need them for trade, and because the alternatives seem riskier. This gives the United States an unparalleled form of soft power. As the 21st century unfolds, the future of the dollar will depend on how the U.S. manages its fiscal policy, its political stability, and its global relationships. It will also depend on whether rivals can create credible alternatives with deep markets and rule of law. Some analysts believe a multipolar currency world is inevitable. Others argue the dollar will continue to dominate thanks to the sheer size and liquidity of U.S. markets. What is clear is that the dollar's rise was not accidental. It was built on the United States' economic might, wartime resilience, strategic diplomacy, and the deliberate construction of institutions that link the world to its financial system. From Bretton Woods to the Petrodollar system, each step reinforced the dollar's role until it became woven into the fabric of global commerce. When you hold a US dollar note, you are holding more than a piece of paper. You are holding a claim on the most trusted financial system on Earth, a ticket to the world's dominant reserve network, and a symbol of decades of economic and political arrangements that continue to shape global life.